Welcome to the Wealth Blueprint channel. I'm Marcus Hale. As a former portfolio manager turned dividend strategist, I've spent the last 15 years helping clients build wealth through smart investing. And today, I want to share with you a shocking stat that will change the way you think about your portfolio. Did you know that investing just $500 per month in a dividend-focused ETF like VOO with an expense ratio of 0.03% can generate over $1 million in 30 years, assuming a 7% annual return? That's right, $1 million. But here's the thing. Most investors don't know how to optimize their portfolios for maximum returns. They throw their money into a few random stocks or ETFs and hope for the best. But I've seen firsthand the power of a well-crafted portfolio, and I'm here to share my secrets with you. So, let's dive in and explore the world of Dividend Aristocrats. First, let's talk about what Dividend Aristocrats are. These are companies that have increased their dividend payouts for 25 consecutive years or more. That's right, 25 years. And I've worked with clients who have invested in these companies and seen their portfolios thrive as a result. For example, last year I helped a client invest in a dividend-focused ETF with a 3.5% dividend yield and an expense ratio of 0.06%. Over the course of 12 months, their portfolio generated a 10% return, with 5% of that coming from dividends alone. That's the power of Dividend Aristocrats. But here's the thing, not all Dividend Aristocrats are created equal. Some sectors are more concentrated than others, and that can impact your portfolio's performance. For example, the S&P 500 has a tech weight of around 28%, which means that if you're invested in a tech-heavy ETF, you may be overexposed to that sector. And I've seen this happen with clients who have invested in VYM, a dividend-focused ETF with a 2.9% dividend yield and an expense ratio of 0.06%. While VYM has performed well over the long term, its sector concentration can be a concern. That's why it's so important to diversify your portfolio and spread your risk across multiple sectors. Now, I know what you're thinking. How do I optimize my portfolio for maximum returns? Well, it all starts with a solid understanding of the numbers. For example, did you know that the average annual return for the S&P 500 over the last 10 years is around 13.6%, according to data from Yahoo Finance? That's a significant return, but it's not without risk. And that's where Dividend Aristocrats come in. By investing in companies with a proven track record of dividend growth, you can reduce your risk and generate passive income at the same time. But how do you get started? Well, it all starts with a solid investment strategy. For example, you could invest $500 per month in a dividend-focused ETF like JEPI, which has a 3.2% dividend yield and an expense ratio of 0.12%. Over the course of 30 years, that investment could generate over $1.2 million in returns, assuming a 7% annual return. That's the power of compounding. And it's a strategy that I've seen work time and time again with my clients. Now, I know that some of you may be thinking, but what about the risks? What if the market crashes or interest rates rise? Well, those are all valid concerns, but the truth is that Dividend Aristocrats have a proven track record of weathering economic storms. For example, during the 2008 financial crisis, many Dividend Aristocrats continued to pay out dividends, even as the broader market was crashing. And that's because these companies have a strong financial foundation and a commitment to their shareholders. As expert investor Warren Buffett once said, "Our favorite holding period is forever." This quote highlights the importance of long-term investing and the power of compounding. By investing in Dividend Aristocrats and holding onto them for the long term, you can generate significant returns and build wealth over time. Another example of a successful Dividend Aristocrat is Johnson & Johnson, J&J. J&J has increased its dividend payout for 59 consecutive years, making it one of the most reliable dividend payers in the market. With a dividend yield of 2.7% and a history of steady dividend growth, J&J is an attractive option for income-seeking investors. But it's not just about individual stocks. You can also invest in dividend-focused ETFs, such as VIG or DGROW. These ETFs provide broad diversification and a steady stream of dividend income, making them an attractive option for investors who want to simplify their portfolios. Now, let's talk about the benefits of dividend investing. One of the biggest benefits is the potential for passive income. By investing in Dividend Aristocrats, you can generate a steady stream of income that can help you achieve your financial goals. For example, if you invest $100,000 in a dividend-focused ETF with a 4% dividend yield, you can generate $4,000 in annual income, which can be a significant source of passive income. Another benefit of dividend investing is the potential for long-term growth. By investing in companies with a proven track record of dividend growth, you can generate significant returns over the long term. For example, if you invest $100,000 in a dividend-focused ETF with a 7% annual return, you can generate over $1 million in returns over the course of 30 years, assuming a 7% annual return. But it's not just about the numbers. Dividend investing also provides a sense of security and stability. By investing in companies with a proven track record of dividend growth, you can reduce your risk and generate a steady stream of income, which can be a significant source of comfort and security. Now, I know that some of you may be thinking, but what about the fees? Won't I be paying a lot of money in fees and expenses? Well, the truth is that fees and expenses can eat into your returns, but they don't have to. By investing in low-cost ETFs and mutual funds, you can minimize your fees and expenses and maximize your returns. For example, the Schwab US Dividend Equity ETF has an expense ratio of 0.06%, which is significantly lower than the average expense ratio for dividend-focused ETFs. By investing in you can generate a steady stream of dividend income while minimizing your fees and expenses. Another example is the Vanguard Dividend Appreciation Index Fund, VDAX, which has an expense ratio of 0.08%. This fund provides broad diversification and a steady stream of dividend income, making it an attractive option for investors who want to minimize their fees and expenses. Now, let's talk about the importance of diversification. By spreading your risk across multiple sectors and asset classes, you can reduce your risk and generate more stable returns. For example, if you invest in a dividend-focused ETF that is heavily weighted towards the tech sector, you may be overexposed to that sector. By diversifying your portfolio and spreading your risk across multiple sectors, you can reduce your risk and generate more stable returns. One way to diversify your portfolio is to invest in a mix of dividend-focused ETFs and individual stocks. For example, you could invest in a dividend-focused ETF like VIG or DGROW, and then supplement your portfolio with individual stocks like JNJ or KO. By diversifying your portfolio in this way, you can generate a steady stream of dividend income while minimizing your risk. Another way to diversify your portfolio is to invest in international dividend payers. For example, you could invest in a dividend-focused ETF like EFA or VEU, which provides broad diversification and a steady stream of dividend income from international markets. By investing in international dividend payers, you can generate a steady stream of income while minimizing your risk and maximizing your returns. Now, let's talk about the importance of tax efficiency. By investing in tax-efficient ETFs and mutual funds, you can minimize your tax liability and maximize your returns. For example, if you invest in a dividend-focused ETF that is heavily weighted towards tax-inefficient sectors like real estate or utilities, you may be subject to higher taxes. By investing in tax-efficient ETFs and mutual funds, you can minimize your tax liability and maximize your returns. One way to minimize your tax liability is to invest in municipal bond ETFs or tax loss harvesting strategies. For example, you could invest in a municipal bond ETF like MUB or TFI, which provides a steady stream of tax-free income. By investing in municipal bond ETFs, you can generate a steady stream of income while minimizing your tax liability. Another way to minimize your tax liability is to invest in tax-efficient dividend-focused ETFs. For example, you could invest in a dividend-focused ETF like QDF or HDV, which provides a steady stream of dividend income while minimizing your tax liability. By investing in tax-efficient dividend-focused ETFs, you can generate a steady stream of income while minimizing your tax liability and maximizing your returns. In conclusion, Dividend Aristocrats are a powerful tool for building wealth and generating passive income. By investing in companies with a proven track record of dividend growth, you can reduce your risk and generate significant returns over the long term.